Late yesterday evening, we got news that India's largest mortgage lender, HDFC Ltd, has raised their retail prime lending rates by 20 basis points. No surprise, actually, given that funding costs have been on the rise. Still, let's get a quick view in from Keki Mistry, Vice Chairman and CEO at HDFC Ltd. Good morning, Mr. Mistry. Thanks for joining us. Can you explain the backdrop of the rate hike from your perspective, sir?
See, effectively, it's an increase in the funding cost. If you look at bond yields, for example, in July, compared to July, bond yields, even after the credit policy and even after the government reduced their borrowing program, even then bond yields are up by almost 100 basis points on an annualized basis. So bond yields have gone up. So this is a reflection of that. If you see over the last nearly 4 days or 5 days since the credit policy, rates have come down by nearly 50 basis points. But even after that, rates are still 1% higher than what they were. So this will ensure that our spreads remain in the band of 2.2 to 2.35, which has been the way our spreads have been all these years. Also, what happened, Ira, was that in February and March, many of the banks increased the lending rates, at which point of time they did not. Because we believe that February, March interest rates tend to be inflated for a variety of reasons. One is there are tax payments. 40% of the taxes of the year get paid on 15th of March. The other, so a lot of liquidity gets sucked out to the system. Secondly, the government's financial year is 31st March. So a large part of the government spending, they tend to complete by December, January. So in February, March, there is relatively less liquidity infusion in the system. So that, coupled with the outflow of money because of the advanced tax payments, results in rates going artificially very high. So this is a February-March phenomenon. But now that we come to April, we have a much more stable outlook on where rates will be. So that's the reason for the increase in rates.
Mr. Mistry, would you expect that rates would continue to rise over the course of the fiscal year? Even if the RBI doesn't raise rates, the liquidity situation may warrant tightening rates?
I don't think so, at least not in the next 5 to 6 months. One will have to take a call later on during the course of the year because there are so many factors on which interest rates will depend, how the monsoons pan out, what US does on rates, how oil prices pan out. So there are so many uncertainties. But the way things are looking today, I think we are now in a relatively stable interest rate regime.
All right, just a quick last word, Mr. Mistry. There is this process of rationalizing base rates with MCLR, which is ongoing within the banks. Does it impact HDFC at all?
No, it doesn't. It doesn't impact us because the base rate has lost its relevance now because most people have converted their loans from base rate to MCLR. So therefore, there are very few borrowers who would be remaining on a base rate regime. So whether base rates go up or down really doesn't make too much difference to anyone in the system.
All right. Thank you so much, Mr. Mistry. Appreciate you joining us.